Navigating risk in retirement portfolios. He who does not risk will never drink champagne. In today's complex financial seas, if you don't take risks wisely, they can indeed take you. As you prepare to transition into retirement, you're probably thinking about risk more. In today's video, I will cover risk in retirement portfolios. If we haven't met yet, I'm Josh Leonard, President and Financial Advisor at the Leonard Advisory Group, where we help those nearing retirement transition into retirement with intent. I am the host of the Relax It's Retirement podcast and also hold monthly lunch webinars on various topics, helping you prepare for retirement. Make sure to hit that like button, subscribe, and ring the bell to stay updated on all of our latest content designed to help you retire with intent. Let's jump right in. Risk. A simple word that carries vast meanings and implications. From the adrenaline of skydiving to the uncertainty in investments, risk is an inherent part of our lives. Understanding the types of risks and how to manage them is crucial. Today, we will focus on a specific type of risk, that within an investment portfolio. Managing this can mean the difference between a retirement filled with security and one of worry. Even in terms of financial risks, risk can mean different things to different people. One of our jobs as financial advisors is understanding our clients' view of risk and helping them manage biases that might negatively impact them. As you're listening to this video, what word comes to mind when you hear risk in a financial context? Is it danger, uncertainty, opportunity, or thrill? We've asked this question to hundreds of individuals and couples. For couples that have been married for over 40 years, one might be still surprised at their partner's response. As an advisor, when we do a risk assessment with a client, we're seeking to get a risk tolerance. Risk tolerance lets us know what portfolio might fall into a client's comfort range. Many times when we assess the risk in a portfolio that a prospective client is unhappy with, it's due to the portfolio either taking too much or too little risk. This is something that should be occasionally adjusted as attitudes change in life. A question you might be pondering is, in retirement, should I embrace risk or avoid it? It's about balance. While it's tempting to avoid risk and protect what you have, remember you also need to ensure your assets continue to grow to battle risks like unexpected expenses and inflation. The 110-year Consumer Price Index average is 3.27%. While it's not a perfect metric, CPI is widely considered as the gauge for inflation. If we put all of our money under the mattress, it would lose, on average, 3.27% in spending power each year. While this may not seem like a big impact in a single year, over an extended period of time, it'll diminish the power of your retirement savings. So if we don't want to lose spending power and want to grow our assets, investing in stocks can be a great option. However, we must understand the risk in our investments to be able to make it through the hard times. Otherwise, we might end up with expensive mistakes. Let's talk about the sequence of returns risk. For most folks in retirement, they will need to pull from their retirement savings. If withdrawals are made during a market downturn, it can significantly impact your portfolio's health, leaving you with less dollars in your portfolio. If we look at taking a 4% initial withdrawal increased for inflation at 3% per year from $1 million portfolio, investing in something like the S&P 500, it can have wildly different impact based on the sequence of returns. If we look at a time like the year 2000 through the year 2010, the average return of the S&P was about 2.36%. Now, I used some round figures here, and this doesn't perfectly represent a retirement portfolio, but we're going to use this as an example to see the impact on the sequence of returns. If we look in the first year, the portfolio of $1 million and take that 40,000 or 4% withdraw, the return of the S&P was negative in that first year, negative 9%. That would lead us to start out with $873,600 in the second year. Having a negative return again in the second year diminishes the portfolio even further with our withdrawals. The third year, we have another negative year. If we run that out every year from the year 2000 to year 2010, we would have averaged 2.36% investing in the S&P 500. Our withdrawals would have went from $40,000 up to $53,756. And our ending portfolio value would be a little over $422,000. Now, if we go through a different time period, starting in the year 2010, ending in the year 2020, we would have ended with $2.5 million and an average rate of return of 14.23%. So if you have a choice, clearly retire in an up market. Of course, that's never the case, and we don't want to delay retirement or any of our life goals based on stock market performance. Now, that average rate of return, you'd say, well, 14.23, all we need is a higher average rate of return, right? No, this is exactly where sequence of returns, or the order in which those returns comes into play. If we look at the period of 1990 through 2003, we can see an average rate of return of 19.76%, yet the portfolio would end with $1.8 million, so a lower value than we had in the year 2010 through 2020. So the order in which those returns come can make a huge difference in retirement. At the Leonard Advisory Group, we take a 3-bucket approach. The cash bucket covers 3 to 6 months worth of expenses plus any short-term goals. The goal of the cash bucket is to have cash on hand. If we lose money to inflation, that's okay. We need that short-term security. Our income bucket, or the second bucket's goal, is to provide stable income for a 6 to 10-year time period. So here we're going to be pretty conservatively allocated so we don't see big fluctuations like we saw in those stock returns. Now in our growth bucket, we're going to take that risk of the stock market. The goal of the growth bucket is to help replace the income and the cash bucket over time. So we want to take that risk and get those compounding returns over time. There are various techniques for assessing risk. To gauge the risks you're facing, consider stress testing your portfolio. Tools like Monte Carlo simulations and resources like Morningstar's guides to withdrawal rates offer valuable insights to what an appropriate rate of withdrawal might be based on your investment portfolio. A Monte Carlo simulation will run thousands of market return scenarios against your portfolio, even factoring in for things like withdrawals. This can provide a range of expected results to better test your plan. If you're looking to get a shortcut, Morningstar does an annual study looking at safe withdrawal rates. They provide this great table providing guidance on a safe withdrawal rate based on how long you expect to withdraw from your portfolio and the amount held in stocks or equities. In the chart, we can see equity ratings ranging from 100%, again, equities are stocks, so 100% in stocks, all the way down to 0%. If we have 100% in stocks and we only expect to withdraw out of our portfolio for 10 years, Morningstar says we could take 8.3% out per year. If we have a 40-year expected timeline that we're going to be withdrawing from the portfolio, that amount goes down to 2.9%. Conversely, if we have, let's say, half in stocks, over that 10-year time period, we can actually withdraw a little bit more, 9.6%. If we look out over a 40-year time horizon, we can see that number at 3.4%. So if you're looking for a shortcut or a little bit more detailed analysis than the 4% rule we've talked through in previous videos, this table from Morningstar can be a good resource to get a gauge of how much you could be stably withdrawing from your portfolio. Financial advisors like ourselves use different software to help assess risk. We're currently using a tool that assigns a number to each portfolio to see how that fits into a client's risk tolerance. It creates an easy way to assess and communicate that risk so a client can understand the risk that they're under and make sure that we're on the same page. If you're unsure about the risks in your portfolio, our team at the Leonard Advisory Group is here to help. We can offer a personalized review to ensure that you're on a strong path to a secure retirement, including stress testing your portfolio. Thanks for joining me today in this video to understand more about risk in your retirement portfolio. After all, knowledge is power. I hope that you found this video informative. If so, please comment below, click the subscribe button, and click the bell to be notified of our upcoming videos.